Hello, everyone, again. This is Jeffrey Ong, and in this episode, I'm going to talk about how good fund managers can complement your investment portfolio. Do you know that the great late Charlie Munger outsourced almost his entire personal wealth outside of Berkshire Hathaway to Li Lu of Himalaya Capital? Himalaya Capital was reported to achieve 30% compounded annual return since 1998, placing him in the same league as Warren Buffett. One caveat, please remember that these are my personal opinions, and I'm merely sharing what I would do for general educational purposes, so you should do your own due diligence. Why do people invest with a fund manager? First, you may have no interest in investing, but you want your savings to grow above inflation rate. Doesn't mean that you're not interested, means that you don't need to invest. Everybody needs to. You can choose between investing in the S&P 500 ETF, which is the SPY that's listed in New York Stock Exchange, or the NASDAQ ETF, which is QQQ, and several good mutual funds or unit trusts to complement your portfolio. Second, you may be too busy in your business and work to learn about investing in stocks. You may be earning millions in your business and cannot take time away to learn about investing. In this case, a portfolio of ETFs and funds may be suitable for you. Third, even if you're keen to learn how to analyze and pick stocks, you still need a good fund or two to complement you. They may have different investment styles that can reduce the volatility of your portfolio. I mean, the S&P 500 can fall 20 to 30% every 5 years. So if you have a fund that falls less, or better still can rise when the S&P 500 falls, that will be perfect. And last, you can learn from the investment styles of these good fund managers while you're learning the ropes. Some of them can focus on quality, some funds focus on growth, some funds focus on value investing. So how do you assess if a fund is good and can complement your portfolio? First, a fund should beat the benchmark. If it's a US equity fund, it should beat the S&P 500. If it's a global equity fund, it should beat the MSCI World. Second, be patient. Try to hold every fund for at least 3 years. Even the best fund managers will underperform 1 out of 3 years. For example, Terry Smith of Fund Smith achieved 15.3% annualized return since 2010, outperforming the MSCI World by a long shot, which did only 9.3%. But even then, it underperformed in 2021 with 22.1% versus 22.9% for the MSCI World. In 2023, Fundsmith did 12.4% versus 16.8% for MSCI World. And year to date, Fundsmith again underperformed because it's up only 6.8% versus 9.7%. But it doesn't mean that Fundsmith has been bad because it's been outperforming for the last 14 years. Third, a better Sharpe ratio. Sharpe ratio is, in short, the risk-adjusted return or excess return over the standard deviation of the asset excess return. A fund with a higher Sharpe ratio, even though it has a lower return than the benchmark, may help, especially if you need a large sum of money in a short time, or your time horizon is not very long, that is less than 3 years. So if, for example, you are in your 70s and may have large sums of money that you need for medical expenses, or you intend to buy a property in a year or more's time, you may want to raise your Sharpe ratio then to go full on beta on the ETFs and stocks. After all, what if the stock market crashes if you want the money? Also, if you need the money in less than 6 months' time, it's better not to invest in stocks. Just put into fixed deposits or money market funds. So this is an example of a discretionary account that I manage. Year to date, it's up 25.3% over here. Over the last 4.5 years, it's up 13.3% per year versus the MSCI World, which was up 9.1% annualized. So you can see the track record on a year-by-year basis. In 2023, it's up 25%. 2022 is down 30%. 21 is up 25%. 2020 up 22%. And the chart below shows the performance of the discretionary portfolio that I manage, which is over the 4.5 years, up 220%. Another fund manager that I admire a lot, as I mentioned earlier, is Terry Smith of Fundsmith. The fund in the chart above is up 611% since 2010, over 14 years. So I certainly hope to achieve what he has done soon. And at the bottom is the MSCI World. Look at the gap here. The amount of alpha, that means outperformance over the benchmark. So this is an example of how good fund managers can add value to your portfolio. Here's a look at Terry Smith's performance. Even though he has outperformed the benchmark over long periods, there will be periods where he underperforms. For example, his fund has underperformed from 2021 to this year. In 2023, very few fund managers would outperform because of the Magnificent Seven, which was Tesla, Meta, Nvidia, Alphabet, Netflix, Microsoft, and Amazon, which accounted for almost 29% of the S&P 500 market weightage. Together, the 7 stocks achieved 76% return. Without the Magnificent Seven, the index would have risen by only 8%. If you are not crazily overweighted on the 7 stocks, you have underperformed the S&P 500 in 2023. In 2022, only energy stocks were positive. All other sectors were down. So it is impossible for a fund manager to switch from totally energy stocks in 2022 to only the Magnificent Seven in 2023. It would be insane. And you would think that a fund manager is a gambler. Let's look at what a Sharpe ratio is. Well, Sharpe ratio is invented by William F. Sharpe. It is calculated by subtracting the risk-free rate from the expected rate of return. Risk-free rate is usually the 3 months US Treasury bill if you're investing in the US. And then divide that result by the standard deviation of the asset's volatility, which measures the up and down side. In layman terms, any Sharpe ratio greater than 1 is considered very good. A ratio higher than 2.0 is rated as fantastic. A ratio of 3.0 is excellent, and I hardly see it. But then again, remember, MSCI World is about 0.5 over the last 5 years, S&P 500 about 0.6. So if you invest in the ETF itself, the index itself, usually the Sharpe ratio is less than 1. So if you can get a fund that is over the Sharpe ratio of over 1, it does complement your portfolio a lot. Now, what about the stability of cash flow? It's not about just pure returns. Let's look at the importance of stability and less volatility. And when you need cash in the next couple of years, the annualized return of Nasdaq, considered one of the best returns in the last 10 years, was 9.68% per year over the 25 years. Remember, that's just about 1999 to today. Over 20 years, it's 14.5%. Over 10 years, it's 18.6%. That's why everyone says Nasdaq is fantastic, but you got to stretch a longer period to understand it. Over 5 years, it's 21%. 3 years is 12.1%. That sounds fantastic, right? Oh, hey, why don't I just buy the Nasdaq QQQ, right? ETF. Let's say you unfortunately bought the Nasdaq 100 or the QQQ at a peak in 2020. You will suffer a drop from $120 to $20. That's an 83% drop in 2003. In fact, it dropped again to $20 in 2009. That's a double whammy, man. So it only broke even in 2017. How's that? Look at the chart here. So if you're unlucky, it will take you 17 years to break even. I guarantee that you would have even been wiped out if you have leveraged. So my friends, it is important to have stability. It's not a naked full-on Nasdaq QQQ SPY exposure when you don't know when you may need the funds. Don't count on the stock market to stay up when you need money within 3 years. And therefore, a good fund with high Sharpe ratio that is poorly correlated or lowly correlated to the S&P 500 does help. So if you like the video, do like and subscribe to this. We will strive to come up with impactful and insightful educational videos, and I'll see you real soon.